everybody on our chat group has been asking us to ask you about TGIF, 1933 Industries.
Okay, sure. So, 1933 is a company that we own a big slug of stock. We've owned the stock for some time, largely because we just think it's real attractive. Their brands are great, Canahemp, and certainly we think the stock is attractive. That's why we own a lot of it. And in working with the company, we identified some synergies that would allow us to advise them and help them through some strategic relationships. And certainly, we couldn't be happier. We're big fans of the company. We're big fans of the team, and so far so good. It's a good alliance for us, and we think it's going to work out well for everybody.
Sure. So the team that launched 1933 Industries recently launched a company called Weekend Unlimited, which won the symbol POT. Are you invested in that company as well?
No, not right now. 1933 is our vehicle, and certainly we're working with them on a range of different initiatives right now. So it doesn't preclude anything in the future, but right now that's what it is.
Sure. 1933 Industries is focused primarily on U.S. markets, correct? Their hemp brands are certainly focused on the U.S. markets. They have a pretty good operation in Nevada, which was actually what initially attracted us to them. The Nevada market is pretty robust, and their brands are doing real well out there. So, one of the things that we look for at CB1, and we've been doing this for some time now, is because Wall Street doesn't have a presence, in the space yet. There's a lot of inefficiencies, certainly that exist that wouldn't otherwise exist if Wall Street had a more ubiquitous presence, as we believe they will in the years to come, if not the months to come. So certainly we think that as Wall Street adopts, institutions do the work and run the numbers, a lot of these inefficiencies will self-correct over the course of the next, call it 6 months to a year. Sure. Are you seeing more interest in the U.S. companies that are trading on the CSE as we come to sort of like the end of Q1? I've seen a lot of sort of sideways trading in the U.S. names that are trading on the CSE. Why do you think that is?
Well, they've had pretty massive runs. I remember you and I were talking right at the beginning of the year when it felt like the world was falling apart, and we made the comment that last year it felt terrific entering the year, and it turned out to be a pretty terrible year for the space. And this year it felt pretty terrible coming in, and thus far it's turned out to be a pretty good year in the last 2 months. But certainly, one of the things, James, that we think about a lot, and I've been in the markets for 30 years, is really trying to identify asymmetrical risk, asymmetrical opportunities, asymmetrical risk reward in the marketplace. And as we look at the cannabis space and understanding really as a context that of the 750 companies out there, most of them probably aren't going to make it, right? But the ones that do are going to have pretty generational opportunities. And as we look at the asymmetric risk, we like to frame it through the lens of 4 drivers, and that's really time versus policy, right? We believe this is efficacious. We believe that listen, the endocannabinoid system, which helps to regulate neurotransmissions, wasn't even discovered until 1992, and certainly the parallels between the plant and the person are widely unknown. So all of that's going to come through the clinical trials. That's going to take time, but that presents an opportunity, as does the arbitrage of price, as we see it, particularly in the U.S. names, the ability for banking reform to come through, which we do think is going to be a 2019 story, but that's going to open up these companies to access debt financing. It's going to allow a lot of the institutions to participate in the space and articulate that strategy through publicly traded securities. And then finally, the arbitrage of perception. It's not about getting well, it's about getting high. I don't think we need to get into that. We've talked about that every time I've been on. And finally, the arbitrage of liquidity, which is the 4th one. And people look at the $300 billion cannabis global cash crop each year and say that's the total addressable market. We like to look at cannabis and hemp as ingredients, and we think if you look at that and contemplate the optionality and all the end cases, the end products and use cases that we think this is going to go into, we think this is a $2 trillion market cap in a decade versus rough justice $100 billion now. So again,
you look for asymmetrical risk in the marketplace, and we think we're right there with cannabis and hemp.
That's a cool approach. A lot of the companies in the U.S. are basing their growth strategy on one of acquisition of premium opportunities in the cannabis production space and in the consumer packaged goods space. But the federal prohibition kind of forces the U.S. into a fractured set of markets where it's impossible for any one brand to sort of become clearly ascendant, like say a Victoria's Secret would or a DKNY would. So I'm wondering, it must be one challenging piece of work to try to figure out which brands are going to be able to navigate that fractured marketplace while the federal government, moves. Obviously, it's moving towards federal deprohibition. Nobody can really say when that's going to happen yet. But so how do you sort of decide which companies are like the better bets for staying the long course, looking for that asymmetrical risk-reward return scenario?
Yeah, it's a great question. Obviously, it's the artificial impediments to a natural business cycle that have created these the asymmetric opportunities, and that comes with a cost, right? I mean, the cost is really the fractured market you talk about, the shenanigans of listing up in Canada for U.S. operators and the like. But at this point, and it's a great point. It's hard to extrapolate sort of what the brands are. We're looking for things like management integrity, right? We put a high premium on the jockeys versus the horse, and really look for teams that we think have a pretty strong moral compass, but also have a good head on their shoulders with regard to the strategy. That's one element. Footprint is another. Certainly, our MSOs, we have representation in most every state that this is either medically legal or recreationally or adult use legal, and certainly in the states that are starting to flip on the eastern seaboard. And then you have to make a bet on those. Some companies, and Green Growth comes to mind, which we don't own right now. But some companies are really approaching this, which is very interesting, and saying we have the distribution, and now we're going to backfill the brands into that. So that's another strategy. But all in all, it's trying to work with what we have and piece together, what we think are a pretty good portfolio of companies that have, that have a good footprint, good management team, and have executed, right? So we're entering the phase where their premium's going to be on execution, and I think that's where we're going to see a lot of these companies sort of delineate from one another.
Sure. Okay, so Todd, what kind of time horizon are you talking about in your sort of in your mindset, in your strategic sort of approach? It strikes me that from what I'm hearing, it's like you're taking like a 3 to 5 year look from where you're going to start to harvest your investments. Is that more or less where your guys' heads are at?
Yeah, that sounds about right. Now, keep in mind, Wall Street has to adopt, institutions have to adapt, and again, when we talk about those arbitrages, time, price, perception, and liquidity, there's a process, right? The efficacy-driven solutions, that's going to take time to come through the pipe. All part of the sort of the general awareness. And if you look at sort of I've been trading for 30 years, and it's my opinion that all market phases have, all market moves have 3 phases: denial, migration, and panic. And I think we're in the denial phase right now. Federally illegal. Most people still think of Cheech and Chong as opposed to wellness. I think that first cusp is coming, though. I think it's going to be triggered by banking. And once institutions enter the fray, you'll see a genuine migration. And then, I think the current naysayers and the people who really think this is the devil's weed, they'll turn buyer in 2022, 2023 when Goldman makes this the #1 pick. And that's probably where you want to, make some sales. But yeah, 3 to 5 years sounds about right. Not to say that it's not going to be opportunities with a shorter time horizon. We have some trades, we have some investments, mostly investments, but certainly I think this is a longer tail secular bull market. We've been saying it for a couple of years. I still think we're in the early stages.
You bet. All right, Todd, great input as usual. Really appreciate it. We'll leave it there for now. We'll come back to you in due course. Thanks for joining us on this Friday afternoon.